Hello and welcome to the latest in Fitch's series of videos on the global economy. Today, China and the global economy. My name's Charles Seville. Today I'm joined again by our chief economist, Brian Coulton, and by Andrew Fennell, lead analyst on China in our ratings group. Gentlemen, thanks for joining us. Brian, can you set the scene for us in terms of global growth and where China fits in? What's our view on global growth?
Sure. The global economy is actually in pretty good shape, in our opinion. We think in 2017 and 2018 we're going to be looking at well above trend growth rates. Our forecast for global growth in 2018 is actually the fastest rate at 3.1%, fastest rate we'll have seen since the global financial crisis. And what we're seeing is a synchronized recovery in lots of different parts of the world. The business investment cycle is improving here in the US, and we think there's going to be some fiscal support to the economy next year. The Eurozone has probably been the biggest positive surprise. We've previously expected consumer spending to slow in 2016 in the Eurozone as real wage growth slowed down following the rise from early declines in oil prices. But that doesn't seem to have happened. The consumer's been more resilient than we anticipated in the Eurozone. And then in emerging markets, for the large commodity producing countries, they've been through a really severe period of domestic demand adjustment in response to the terms of trade shock that hit in 2014, 2015. But they've kind of come through the other side of that, and what we're seeing now is demand coming back in places like Russia, places like Brazil. And then finally, China, which has been very important. The economy has responded more dramatically to the stimulus measures put in place from mid-2015 than we anticipated. And particularly important, I think, has been the recovery in the housing market. Housing sales and then house building have recovered, and that's been important because that has had a big knock-on multiplier impact on the industrial sector in China, which has seen Chinese import growth recover. That, along with what's happening in the big oil producers, big commodity producers, has seen emerging market import growth recover quite strongly, and that's quite an important part of this better global growth picture. So it's a pretty broad-based story on the geographical front. In terms of the themes that are behind it, we think declining unemployment rates have been very important in underpinning consumer confidence. We think that the shift to an easier fiscal stance in lots of countries has been helping, and we're also seeing clear evidence that the ECB's monetary policy is gaining traction in terms of the economy. So the next couple of years it's a pretty decent story.
Okay, and turning to policy now, we've seen global central banks starting to tighten or talk about tightening policy. What about the Chinese authorities?
Maybe sticking with the global picture for a bit. I mean, while we're more optimistic on the short-term outlook, 2017, 2018, we think that's probably about as good as it gets, actually. And when we look 5 years out and we examine sort of the prospects for potential growth, particularly in the advanced economies, we're still quite sober on that outlook. And so what we're seeing is a rate of growth at the moment, and it's going to last for another 18 months or so, which is looking significantly faster than these economies' capacity to grow in the medium term. So we are going to get a slowdown after 2018, we think, in the advanced countries. But also quite relevant in terms of the policy outlook is that we're seeing whatever output gap we may have now, and we do think there's probably a bit of a negative output gap in most of the advanced countries, it's going to be closing quite rapidly. And so by the time we get to the end of next year, there's not going to be much spare capacity left in the US or even the Eurozone. So that's going to be an important change in the context in which central banks are making their decisions about monetary policy. And our view is actually that global monetary policy is going to be going through a normalisation phase, which is going to be quite pronounced over the next 3 or 4 years. We don't really see that central banks are going to be comfortable with maintaining their current exceptionally accommodative stance. Now that the economy has recovered, now that the downside inflation, the sort of deflation risks have diminished quite sharply, economies have normalised, and I think monetary policy will normalise. We actually think the Fed is going to be raising rates 3 or 4 times a year through 2019. That's a significant change in the monetary policy outlook. It's not a view that the market currently seems to subscribe to, and it's going to have implications for other countries. As far as China's concerned, we have seen a backup in interest rates in the last several months. We think we're now seeing some evidence of credit credit growth slowing a little bit. We think that backup in rates has probably gone as far as the authorities are comfortable with. We don't see a significant further tightening from here. But that doesn't mean that the impacts of the tightening we've had to date, I think we will be seeing those impacts on the economy.
Andrew, turning to you now, we've seen in the past few months some pressure on the exchange rate, capital outflows out of China. What's the update there? What have the authorities done about that? Are we concerned about it?
I guess one key development is that really the pressure on capital outflows, this has been, the onset of capital outflows started probably in mid-2014, but the authorities have put in a number of policies to contain capital outflows. So we've seen, for example, increased scrutiny of outbound FDI transactions, as well as increased scrutiny of individuals kind of remitting foreign currency. And so really in the first quarter of this year, capital outflows have declined quite dramatically. And really what we've been highlighting is that there's been kind of an asymmetric treatment of the capital account recently. So it's been much more difficult to remit foreign currency overseas. At the same time that the Chinese authorities have actually made it much easier to bring money into China. And so that's really had kind of a stabilizing effect on the capital account in China.
Right. And how do we see the progress of the sort of internationalization of the renminbi, and how important is that for our credit view on China?
Yeah, so in the short run, I guess these policies to contain capital outflows have been positive, actually positive from a rating perspective, because it's preserved the strength of the external balance sheet. But the cost of this has been actually, I think, in our view, really this broader policy effort to internationalize the currency. And so what we've seen, if you look at SWIFT payments data and you look at the 4 offshore trading centers of the CNH, what you see is that offshore deposits in renminbi terms have declined since 2015. And if you overlay that with kind of our, in the sovereign ratings world, we use the IMF's COFR data to track basically renminbi denominated assets held by global central banks. And this has also shown a modest but a decline. And actually, if I pivot back to Brian's view on Fed rates, one thing that's striking to us is that capital outflow pressures tend to coincide in China with a rising dollar. And so as the dollar rises, capital outflow pressures tend to emerge. And basically since the beginning of this year, we've been in a pretty favorable external environment for China. And so our baseline continues to be that we will have resurgence in capital outflow pressures probably towards the end of this year or perhaps early next year. And so if you do subscribe to this view that we are going to have continued rise in global rates, this capital outflow story is probably not yet done.
And really, what do you see as the biggest risk to the outlook, the sort of biggest concerns as far as the credit goes? We know that there's been a massive rise in leverage in China. How concerned are you about that?
Yeah, so policy settings continues to be the #1 rating sensitivity for China. And yes, we do think that policy settings have contributed to the rise in imbalances in the economy. But I think one thing that's pretty remarkable is that if you go back 2 years, there wasn't really a recognition in China that the economy had a debt problem. But in recent years, and particularly over the past year, I think there really has been a quite dramatic change in thinking by policymakers. And so if you look at Premier Li Keqiang's government work report at the National People's Congress in March, if you look through that document, financial stability has been highlighted as a very key area of concern for the government. And in April, President Xi also identified this as a national security concern. He equated basically financial stability with national security. And regulators have also followed up with this. And so the CBRC and the PBOC have also put in regulations to kind of bring financial stability to the forefront of policy concerns. So we do think there's an evolution in thinking, but there hasn't been a relaxation yet in growth targets. And so we're continuing, from a ratings perspective, continuing to balance what we see as positive trends, but with what we see as kind of a problem in the structural growth model for China.
And what is happening to credit growth? I mean, they've been talking about restricting credit growth and addressing these concerns, but has anything actually changed on the ground?
Yeah, so it really depends on the figures you look at, because if you look at official aggregate financing, credit growth has actually been pretty stable. But if you broaden that out and look at some of this broader measures of activity, we do start to see a deceleration in credit growth. But I think, one thing worth highlighting is that we don't expect policymakers to want to stop credit growth or slow it down significantly. In fact, one of the CBRC regulations, I think it's number 4, identifies that banks should improve support to the real economy. And so I think the risks that policymakers are trying to address is that credit growth was finding its way to NBFIs, it was finding its way into other parts of the financial system, and then finding its way into speculative activity. And this kind of risky behavior is the key thing that policymakers are trying to contain at the moment, not stop the flow of credit to the real economy.
Maybe I could just follow up on the credit and what it means from a sort of macro sense. I mean, when we think about the short term, we have seen this slowdown in credit. It's still growing much faster than nominal GDP, but there has been a deceleration. And what we find when we look at the data is that there's a very good correlation between the rate of acceleration or deceleration in the stock of credit with the housing demand cycle. So housing sales in China, the last 3 peaks in housing sales have all been associated with an acceleration in credit and vice versa. Now, what we saw from late 2015, early 2016 was the credit impulse, if you like, improved, credit accelerated, started growing more rapidly, and lo and behold, housing sales have recovered. What we've seen from about the beginning of this year is actually quite a significant slowdown in the rate of credit growth and a decline in the credit impulse. And if the relationship that we have seen historically between credit and housing sales continues to hold, and maybe that won't happen, but it's a pretty good correlation. If it does continue to hold, we're going to see a slowdown in housing sales going into the second half of this year, and that is something that's one of the key drivers of our forecast, that Chinese growth, while it's easily going to hit the government's target this year, likely to exceed it, we do think we're going to see slower growth in China in 2018. So that's the sort of the near-term outlook. From a medium-term perspective, there is still this issue out there, which clearly we know that credit to GDP can't carry on rising forever. So we have to think about what are the scenarios where credit growth does fall to a rate that's more in line with nominal GDP. Now that's not going to happen quickly, but when you look at the scenarios that sort of embed that assumption, the logic is really that in order to slow credit down, you need to slow down the rate at which the corporate sector is borrowing. And the corporate sector is borrowing essentially because investment far exceeds retained profits. Now, unless we have some windfall improvement in profits, or there's a big pressure on costs and labour costs, which itself would be growth negative, it's really got to be investment that adjusts it in order to slow the pace of borrowing down. The problem China has is that investment is a very big chunk of domestic demand. So if you slow investment down in order to reduce the rate of credit growth, it's going to have growth implications, and that's really the conundrum that is sort of raising concerns for us from a medium-term perspective about whether China can continue to get the demand growth that it needs to deliver its own growth targets, and we're not sure, we're not quite sure how the arithmetic adds up in terms of if the government seeks a path where credit to GDP stabilises. The implications for investment that go with that would take quite a toll on growth.
Which actually brings me on to my last question, which was about rebalancing. Are we seeing any kind of meaningful rebalancing in the sources of growth in China away from investment and towards consumption?
So if you look at consumption data, actually consumption has continued to, at least since 2015, contribute more to overall growth and investment. So we do see very strong signs of rebalancing both on the consumption side as well as on the services side. We think this is positive for China in the longer term, but it does pose a significant policy challenge, because what you've had is, with a rebalancing in the economy towards consumption, we've had a decline in the savings rate. But in order to achieve these high growth targets, investment hasn't declined by the same rate as savings. And so what you've had is a narrowing of the savings investment gap and a narrowing of the current account balance. And now, right now, China continues to run a current account surplus, and we expect it to do so over our forecast period. But it's not hard to envision a scenario where the current account continues to narrow and eventually may approach something like zero. Now, from a from a mathematical perspective, a lower current account balance is the same thing as a capital outflow, and so this could introduce pressures, more pressures on the currency and on capital outflows in the future. And also, it makes you think about long-term financial stability concerns as well, because to the extent that our view continues to be that China will not have a hard landing and that it can work through these asset quality problems over the medium term. But that is dependent on the financial system being kind of sealed to the external world and not really depending on external capital. And so to the extent that this savings investment gap changes that dynamic, that could introduce some risk for policymaking over the medium term.
I think the other aspect of the rebalancing story that I think is worth focusing on is, you know, China's had a lot of very intensive investment-driven and a very investment-intensive driven growth model for a long time now, and that continues, as Andrew says. Even though consumption is speeding up, we've still got a rapid growth of investment. And what we've seen over the years, particularly since 2008, is that the efficiency of additional investment is getting less and less. We're getting less and less extra GDP for each additional unit of capital stock, and so there's a productivity problem there in terms of a slowdown in investment or capital productivity, and you know, that's really something China needs to address in the medium term if it's going to be able to continue to grow at the sort of rates that it wants to grow. And that really comes down to whether they can do, you know, reforms that help to improve the allocation of capital. And obviously we've got a very important political transition coming up. I don't know what our view is on whether that's going to improve, but I think reforms will be very important to address that productivity issue.
Yeah, there are actually one key question from investors is what we expect post the 19th Party Congress, whether there's going to be a significant pivot in economic policy. I think, you know, really what we've been articulating to investors is that in our minds there's been two signature policies in President Xi's tenure over the past 5 years. The first signature policy has been a strengthening of the party and its influence, and the second one has really been increasing China's influence in profile on the global stage. And so we don't really subscribe to the view that there's going to be a dramatic pivot in economic policy. We think that there are going to continue to be supply-side structural reforms in many of the policies that have already been articulated, and perhaps they're going to go further in those policies, but we don't see a dramatic pivot in that sense. Another key question we've been getting is, well, what do we expect for economic growth targets over the medium term, and is there a possibility that China would perhaps get rid of the growth target altogether or significantly relax those growth targets? And I guess, you know, the best basis to analyze this problem that we have is really to look back in history. And I think, you know, every party Congress, the president will present a work report, a political report that basically summarizes the past 5 years and the future. And in this work report, the authorities have been identifying achieving a moderately prosperous society. They've been doing so since 2002. And this moderately prosperous society is basically equated with this idea to double GDP by 2020. And so we think there's probably a continuity to policy that's actually been there for about 15 years that probably means that a dramatic change in the settings and in the GDP growth target being an important policy anchor is probably not going to, it's not going to be dramatically relaxed.
Well, Andrew, thanks very much. Thank you, Brian. Thank you for watching.